Welcome everyone to our 2020 mid-year outlook, where we will cover the economy and financial markets over the second half of the year. I'm Anthony Valeri, Director of Investment Management. With me is Robert Spendlove, Economic and Public Policy Officer. And we're going to take the next 20 minutes or so to cover the economy, stocks, and bonds, and also take a look at the election and what the markets may say about the election, as well as how they may respond. So why don't we go ahead and get started? And Robert, I will turn it over to you for an outlook and update on the economy.
Great. Thanks, Anthony. It's great to be with you today. We really are experiencing historic times right now. What we're experiencing is epitomizes the classic black swan effect, where we've seen a dramatic impact. It was unexpected, and it's been severe in a very short period of time. And we've seen that effect across a number of different economic indicators, from employment to GDP to consumer spending, consumer confidence. All of those are illustrating the shock to the system that we're experiencing. Now, in a period like now, it's so important to have that support from the federal government. That individuals and companies and states just do not have the resources to be able to deal with this situation on their own, and so it's essential to have that kind of high level support from Congress and the Fed. But then, of course, ultimately, the economy will be and is being driven by the virus, and so that's going to, in many ways, dictate how we come out of the recession. So, just looking at employment as one of those indicators, on the first Friday of every month, the Labor Department releases their monthly jobs report, and you can really see the dramatic impact of the hit in those numbers. To put in perspective, during the Great Recession from 2008 to 2010, really started in 2007, but most of the impacts were in 08 and 09. We lost about 8.7 million jobs, and that was a big impact on the economy. In the month of April of 2020 alone, we lost 20 million jobs. Now, in the last few months, we've seen job growth coming back. In fact, we've seen about 7.5 million jobs added in May and June, which is the largest increases in employment that we've ever seen. But even with that, there's still about 14 million people today that are unemployed. When we look at what does this mean compared to other recessions? So what we did here was take the last several recessions going back to 1953, looking at the impact on employment and the duration. So how long did it take for those jobs to return back to the pre-recession peak? And you see the Great Recession, where it was much deeper, much more dramatic than past recessions, and took a long time to recover. It was over 6 years to return back to the pre-recession levels. Looking at the current recession, has been even more dramatic, dropping very quickly to a much lower level. But we are seeing that kind of strong recovery, and so economists talk about different types or shapes of recoveries. Is this going to be a V, or is it going to be a U or a W, where we see maybe a double dip recession? That remains to be seen, but the important thing to keep in mind was that the economy was fundamentally sound before the pandemic hit and before the recession hit. And so it's just a matter of kind of returning back to those pre-recession levels. And you can see that also with our latest measure of GDP. The gross domestic product is the broadest measure of our economy, and the data for GDP shows that in the second quarter it dropped by 32.9%, the largest drop that we've ever seen in GDP. To even be able to compare that. So GDP is a kind of the current measure, gross domestic product, and that data series has been collected since about 1948. So going back to 1940, now there are earlier measures, whether it's gross national product or others, that would pull in the Great Depression, which we would probably see larger drops than we're seeing here. But going back to 1948, we have to go to the second quarter of 1957, saw a 10% decline in gross domestic product. And this is much larger than that and happened much more quickly. So we're now in our second consecutive quarter of negative GDP. And the important thing to look at here is that dark blue part of the graph, which is consumer spending. Consumer spending is 2/3 of the economy. And if the consumer continues to have confidence and spend, then it will hold up the economy. But if, as we saw in the first and second quarters, consumer spending drops, consumers step away, it pulls the overall economy into contraction. So the Fed has been very aggressive in addressing this. The Fed cut the federal funds rate to 0 and has said it will stay at that level for the foreseeable future. In fact, recently Jerome Powell was asked, when will the Fed start increasing interest rates again? And he said, this is a quote, he said, we're not thinking about increasing interest rates. And that shows the Fed's commitment to making sure that the economy has the tools it needs and individuals have the tools they need to be able to come through. Also, looking at inflation, inflation remains low. And so the Fed doesn't need to be, there's no pressure for the Fed to be increasing interest rates. Generally, when interest rates are going up, the Fed needs to raise interest rates to combat that growth, especially if it's above their stated 2% goal. But what we're seeing is inflation much lower than the goal and actually closing in on deflationary pressures. So the Fed is definitely justified in keeping rates very low. Looking at fiscal policy, not only has the U.S. Congress, but countries around the world have shown a commitment to making sure that that individuals and companies and state and local governments have the tools they need to be able to fight the virus. The original CARES Act spent about $3 trillion, and we're now discussing the next CARES Act or HEROES Act. That could be anywhere from $1 to $4 trillion. And we'll see things like extending unemployment benefits, individual checks to families around the country, and more support for hospitals and maybe for state and governments as well.
Well, thank you, Rob. Very thorough review of the economy. Appreciate that, and love that Powell quote. I'm sure he loved delivering that to the media as well. So, well, certainly what Fed Chairman Powell and his cohorts at the Fed have done has been very supportive of the stock market. In fact, that's a big reason why we've had such a strong bounce back from the March 2020 lows. But it is going to be a bumpy recovery even after the strong bounce back that we had from the March 2020 lows. I should add that we do not expect a revisiting of the March 23 low. There's just too much stimulus, both from the Fed and Congress, and some bona fide improvement in the economic data. But still, as Robert mentioned, a long way to go. Markets have priced in a lot of good news, and that's led to expensive valuations. And to help understand that, you need to look at the longer term horizon, which investors do. The PE ratio is high, but investors are anticipating a longer term profits recovery. We'll talk about that. We do expect a volatile low return environment over the second half of 2020, and by low return, flat to low single digits. Much of the strength in the rebound is borrowed from future returns. Do expect any correction or pullback to be viable, however, absent any material change in the virus or economic data. And longer term, still expect stocks to beat bonds. We certainly find them more attractive and believe as cash is punitive, so it pays to have a diversified investment approach. As we look at the a typical bear market, and from two perspectives, both the length of the bear market, and the bear market is defined as a 20% decline or more in the stock market, and also the time to recover from that decline. You can see that if you break up recessions into different, what causes the recession? Is it something structural that changes in the economy? Is it cyclical, which is a traditional recession where an area of the economy experiences some sort of excess and then we have a recession? Or is it event driven from some sort of outside shock, which the coronavirus certainly qualifies as event driven? And you can see historically that the average length of a bear market when it's event-driven has been shorter. It's been about 6 months if you look at this chart, and the average time to recover is about 15 months. So it's certainly been shorter, and I think the current environment will reflect that. And certain parts of the stock market have already recovered, such as the tech-heavy NASDAQ, but other segments, international stocks, small company stocks, still have some recovery to go. So still going to be a long recovery, going to take some time, but we do expect this event to the stock market to recover, even if it is going to be choppy and perhaps a lower return environment over the remainder of the year. Let's look at valuations, and this is the PE ratio, trailing PE ratio, and you can see how it's increased up to 24. The historical average is about 19.5, at least for this time period, and you can see that even post 2009, that PE ratio spiked higher. And a lot of that is simply because profits erode. And if prices increase or stay stable, then that PE ratio is going to increase. So part of this is normal activity. The other part is simply the fact that the market is pricing in a recovery in 2021 and 2022. And you have to keep in mind, from an investment standpoint, when you buy stocks, you're looking at a stream of future profits, not just 1 year. And that's why the market's expensive just looking at the current PE. We think fair value is probably a little lower than where the market's trading here. But again, it's impossible to time the market. And even with our expectation of a low return environment, still calling to stay invested and benefit from the equity market over longer periods of times. Speaking of earnings, and this is really the key watch for us that drives the equity market, the current expectation is that profits max out at a 24% decline. And this is held stable over recent weeks. In fact, if anything, profit estimates have increased, and that's provided a key support for the equity market. However, it's going to take a long time to see if these measures are correct. So second quarter earnings thus far, we're about halfway through, proceeding slightly better than expectations, but expectations were very low. If we look at the third quarter and fourth quarter, still much information to be gleaned. So it's going to take several months to know if this profit expectation is accurate, and this could be a source of volatility for the market. So to the extent that this forecast gets revised lower, we could see some pressure on stocks. If it stays where it is now, that would mean that would likely augur for a quicker return or the market being more resilient. But it's something to watch. The average decline in a bear market for profits has been 36%, and you can see the reaction from prior bear markets, all of those in response to recessions. So a little bit below average for the current, but we have much more to go. And again, this could be a source of volatility depending on the extent of the profit recovery. We'll keep you updated on that progress in subsequent webinars. And if we look at areas of the stock market, the U.S. has been a standout, especially large cap U.S. over the last few years. This chart shows performance of international developed stocks versus U.S. A declining line means U.S. stocks have outperformed international and vice versa. You can see it's been a multi-year trend of U.S. outperforming international, but over the last few weeks, that trend has stabilized and started to reverse. Part of that's due to the better response and handling of the virus in Europe. It also reflects cheaper valuations. International stocks have been more cheaply valued in the U.S. for some time. But that, with the combination of a weaker dollar, may be the trigger to create a change in trend here in U.S. versus international. Now, we still see the longer-term prospects as better in the U.S. They will still comprise the majority of our equity allocation. But this speaks to the benefit of diversification, and having international bounce back provides a source of return and also a better source of value within a diversified stock portfolio. So some help from international, especially emerging market, which is not reflected in this chart, which since the beginning of the June has been the best performing geographical segment of the equity market. Now, if we look towards the election, a couple charts or a few charts here I'd like to go over. First, can the stock market predict the election outcome? Well, if you go back to 1928, the stock market's actually done a pretty good job of forecasting who will win the election in November. If you look at the total return from August, September, and October, just those 3 months, it'll tell you a good deal who may win. So if the market is higher in the 3 months leading up to the election, again, August through October, then the incumbent party has won. In the event that the stock market is lower over those 3 months, the incumbent party has lost. And that is held true in all but 3 elections are highlighted in gray there, 1956, 68, and 80. So 84% success rate, which is pretty strong. So it's important. This could be something to watch as we get closer to the election. How does the stock market feel about the potential, or what is it about the potential winner of the election? And then whether the incumbent loses or not could also play a role. This chart shows the historical path of the S&P 500 performance from 1936 through 2016. And if the incumbent party wins, which is the gold line, stock market has certainly preferred that. It's been more of a steady ascent. It's also been obviously a smoother ride. Stock market doesn't like change in policy or uncertainty. But the blue line shows if the incumbent party loses, then September and October have tended to be volatile months seeing losses. So something to watch as we get closer to the election. This could definitely be a source of volatility in the equity markets. And then finally, the key point I really want to leave you with regards to the election is that no matter who is in charge, stock market performance has been pretty good. And this is our profits over politics mantra. This shows the S&P 500 total return under various political regimes since 1950, whether it's a Democratic president, a Republican president, whether Congress is united under one party, or whether it's split. Returns are better under a Democratic president, but even in the worst case scenario, which is a Republican president, Republican Congress, and worse in the sense of historical data, not making a political view there, but just to show that under all those scenarios are pretty strong, and they both suggest, all the scenarios suggest pretty strong returns for stocks. And this really speaks to the fact that over the long run, it's about the economy, it's about corporate profits that will ultimately drive the stock market and not the leadership in Washington. Let me switch gears to the bond market before we conclude. And we do believe bond yields are going to stay low for a very long time, given the Fed's commitment to hold rates low through 2022. That's 2.5 years, so a long way to go. We do think the Fed will stick to that. That is going to create a lot of stability in the fixed income market, very low yield. So how do you get incremental yield or return? Well, we think it pays to be diversified. Corporate bonds and mortgage-backed securities, those segments of the bond market offer ways to boost yield and add to return. Within the high-quality segment, we think municipal bonds are attractive. We'll touch more on that in a moment. And most importantly, despite the low yields, and I know on a surface level, some people have an aversion to that, but really high-quality bonds are still an important risk mitigation tool in a diversified portfolio. If we do have a 10, 15% pullback in the stock market, that high quality bond allocation, even if it is low yielding, will remain certainly much more stable and be a key diversification offset like it always has been historically through periods of stock market volatility. So important to have that risk mitigation tool in your portfolio. To get an idea of what bond returns will be and just to set expectations, the 10-year Treasury yield is a good predictor of future returns. That's the blue line. On this chart, I shifted it forward 10 years to show what future return might look like. And you can see the gold line, that's the Bloomberg Barclays Aggregate Bond Index, sort of the S&P 500, if you will, of the bond market. So a broad measure of a high quality bond market. And you can see how closely the total return on a 10-year annualized basis tracks the yield. Now, I do mention the 10-year annualized basis. Some years will be higher in terms of returns, some lower, but it gives you an indication of a long-term average return, which based on the 10-year yield would show you the tend to indicate a 1% type total return. We think it's going to be a little higher than that based on those corporate and mortgage-backed sectors in the taxable bond market. But still looking at a low return environment, so investors looking for those higher returns at some point need to consider boosting their equity allocation. Maybe not right away, but at some point in the future, just to know that this is what we are staring at in the next few years in the bond market. Again, key risk mitigation tool, but in terms of return, it's, I think, important to have this understanding. And then as we move to the municipal bond market, one of the reasons we like munis is because the valuation relative to treasuries is attractive. And the one way to measure that is to chart the ratio of AAA municipal yields, so the highest quality municipal yields, as a percent of treasuries. The gold line is the 30-year, blue line is the 10-year, and typically muni yields or top muni yields should yield less than treasuries because they're tax exempt. And those tax exempt yields should roughly corroborate to what's offered in the treasury market. But earlier this year, there was a disruption, as you can see there on the right side of the chart. Munis went into very attractive territory. They have since improved, but through the end of June, early July, cheapened relative to treasuries, and that's more a function of the strength of the treasury market in recent weeks. But still, an attractive valuation relative to history. And it's for investors who, one, need some safety, and two, looking for or in a higher tax bracket, municipals could really provide some better value here. Also, if there is an increase in taxes as a result of a change in leadership in Washington after the election, that could really provide an additional tailwind for municipal bonds that, of course, are exempt from any increase in taxes. So munis stand out in the fixed income market on the high quality side. And with that, I'd like to say thank you, taking the time to listen to our webinar. We'll, of course, do more in the future, but thank you to Robert. Thank you all for listening. We look forward to speaking to you again soon.